This conference will now be recorded.
All right. So today we're going to talk about miscellaneous personal lines. All right. So these are the items that kind of fill in some of the gaps left by your other coverages or expand on some of the coverages. And in some cases to help personalize the policy to meet your individual unique needs. So let's go ahead and dive in here. What we're going to cover, we're going to talk about different boat policies, umbrella policies versus excess liability floaters. We'll talk about the flood program, the FAIR plan, and earthquake coverage. And I'm using California because here in California, if you sell property insurance, you have to offer earthquake coverage. People don't have to take it, but you have to offer it. In other states, it's not required to be offered. And so, but if they do offer it, there's different ways that they can offer it. We're going to discuss that. So options for watercraft.
Oh, yeah, okay. Yeah.
Right. Let's meet that one. All right, so options for watercraft. I mean, realistically, if you just have a small bass fishing boat or maybe a canoe or rowboat, maybe small, horsepower engine, you can cover it under your homeowner's policy. In fact, by adding the watercraft, it's called the Watercraft endorsement, and it basically covers liability and medical payments for scheduled watercraft. Now, whenever you see the word scheduled, it means I need a list of what it is. I need to know that it's an 18-foot bass fishing boat with a 15 horsepower engine. All right, so that's what the schedule means. It means we have a description of what that property is. But your homeowner's policy doesn't cover you and your family members if you slip and fall in your house. I mean, you should have health insurance if you're injured. So by adding your watercraft or your boat to your home policy, it's going to mimic your homeowner's policy. That means it's going to provide liability and medical payments to others, not to you and your family. Again, you should have health insurance to cover you and your family if you're injured. All right. So scheduled watercraft and, again, liability and medical for others. All right, like a guest on your boat, just like a guest at your house during your cocktail party. To be covered, it typically cannot have more than 25 horsepower engine. If it's a sailboat, sailboat cannot be larger than 26 feet. Now, this is a limited type of program, so it only pays about $1,000 for that small watercraft. To be better covered while using your boat or for your watercraft, then you might want to look at a boat owner's policy or boat owner's coverage. And a boat owner's policy is similar in design to an auto policy. That means you have liability in case you hit someone and you injure them. There's liability for you and your family on your boat and your friends and guests that are on your boat. You also have physical damage coverage for the boat. That's just like auto. You have liability in case you hit something, medical for you and your passengers in your car, and physical damage for the car. So that's, again, a boat owner's policy. And this is a common test question, by the way. A boat owner's policy is similar in design to which of the following, and you want to pick an auto policy. Right? You can get trailer coverage, right? Because you're using a trailer to transport that watercraft in a lot of cases, and so that's going to be an optional coverage. And when you hear boat owners, think of, lakes, rivers, inland areas, not ocean going. That's a whole nother world. So just think of inland lakes and rivers, okay? Water skiing out in Lake Havasu or something. All right. Come on. All right, here we go. So now, inland versus marine. Now, I'm using inland, which means like small bodies of water, and that's a boat owner's policy. Like I said, the coverages are liability, medical, physical damage, and the optional trailer coverage. If you're going in the ocean, it's typically a different shaped hull to keep that boat afloat in large body masses of water. And so we're going to flip over to what's called a yacht coverage or yacht policy. So instead of liability and medical, we're now going to call it protection and indemnity or P&I coverage. It includes liability and medical built in. Another thing that's typically included with your P&I coverage on your yacht policy is workers' compensation for the captain and crew. Now, I'm not saying this is like a cruise ship. It's like you have an ocean-going yacht, and you hire a captain and crew to take you and your family to, maybe Hawaii, right? And so since you hired them to take your family around, that's still kind of a personal use. and that workers' comp can be covered under the protection and indemnity portion of the policy. Right? Just so you know. Hull coverage covers the ship itself. That's the engine, the motor, including the gasoline. Now, you might see gasoline or fuel, and even though the gas is in a tank, it's meant to be in the engine, and the engine is attached to the ship. That's why gasoline is actually covered under hull coverage, because it's, in a sense, part of the ship. You need to understand that. Again, for yachts, if you do transport it or you have to dry dock it for a while, we have to move it, and there is some trailer coverage. It's optional. And with ocean-going vessels, we have navigational limits. You know, your personal auto, we have territorial limits. Like your personal auto policy, your insurance companies will cover you pretty much anywhere in the U.S. territories, like Puerto Rico or Guam, and also Canada, because their laws are similar to ours. Right? Innocent till proven guilty. But for autos, the territorial limit is we won't cover you in Mexico at all. Now, keep that in mind also. Your personal auto policy does not provide coverage in Mexico at all. That's one question. There's another question. If you purchase the limited Mexico coverage endorsement, then it can cover you up to 25 miles into Mexico from the U.S. border for no more than 10 days. Right? But in general, the personal auto policy doesn't cover you in Mexico at all. That's a territorial limit. So with yacht, for ocean-going vessels, we do have navigational limits. There are some hostile waters where your insurance companies will not cover you. Believe it or not, now off the coast of parts of Mexico, parts of the Caribbean, and of course off the coast of Somalia because of the pirates. All right, and so those are navigational limits. Now you can still venture in those areas, but just know that the insurance company will not cover because it is an excluded region. Right. So on land, territorial limits. On water, navigational limits. Now, our ocean marine that we just talked about, your yacht policy, that's personal use of a vessel. That's you and your family have a nice yacht and you travel around on your vacation. Now, ocean marine coverage is business use of a large ocean-going vessel. And so the coverages are kind of similar. We do have hull, which covers the ship itself, the engine, the motor, including the gasoline. And we have protection and indemnity, which is liability and medical, and of course, workers' compensation for the captain and crew. Right. What's not covered on your personal auto policy is cargo and freight coverage. This is for a business. So cargo, we're transporting crates, right? You know, like the big shipping vessels, right? The big, large ships carrying the containers, right? That's what the cargo is. And freight would be reimbursing the shipping charges. So if your ocean, maybe you're shipping some crates from another country over here to the U.S. and you're paying to have the crate shipped, and they have a loss at sea where your crate goes overboard, right, and never to be found again. Not only did you lose the crate, which is the cargo you're paying to have shipped, you lost the money you paid to have the crate shipped. So cargo covers the crate you lost. Freight coverage reimburses the money you paid to have the crate shipped. So it's kind of like reimbursing a stamp. All right, so that's kind of the ocean marine coverage. Now, for personal boats, you won't have cargo or freight coverage. This is a business use. So make sure you understand when you're going through the test, is this a personal situation? Is this a business use? Anytime you're charging passengers a fee like this cruise ship, that's a business use. If you're using your small watercraft or your small boat as a taxi, like a water taxi, where you're charging passengers a fee, that's going to be business use. It's not covered by your personal boat owner's policy. Now, it's okay to have a business party on your yacht. You know, maybe you have you go out on the bay because maybe it's a company business party, but you're not charging a fee. That's actually allowable. Now, another tricky part about boat owners, I just want to make you aware of, occasional boat races among friends, that's covered. You know, you meet up with your friends like, hey, dude, I'll race you to that buoy for like a 12-pack, right? And you get into an accident and that's actually covered. Occasional boat races among friends is covered. But if you register in an organized, sanctioned race, there is no coverage. In an actual race, right, sanctioned race, the risk increases dramatically, and the insurance companies will not basically manage that risk, so they exclude that. So again, occasional boat races among friends is okay, but if you register in an organized sanctioned race, there is no coverage. All right. Umbrella coverage. Well, umbrella is excess liability above underlying coverages. All right. So when you think of umbrella, think of higher limits, broader coverage. Now, before you can get an umbrella policy, you got to have these primary policies. As you can see the list here, I've got personal liability. Now, this personal liability is like liability associated with a home, okay? Or, maybe you're a landlord, you have a dwelling policy, maybe a 3-unit building where you live in one unit and you rent out the other 2. And so if you have a dwelling policy with the personal liability endorsement, that would qualify as personal liability, right? Now, sometimes that's called a CPL, Comprehensive Personal Liability. But you have to have at least minimum $300,000 of personal liability on your home policy or an endorsement added to your dwelling policy. Right? By the way, an HO4 for renters and an HO6, which is for condos, those are actually homeowners policies. HO4, HO is homeowners, broad form, which is the 4 form, and it's a homeowners policy designed for a renter. HO6 is a homeowner's policy designed for someone who owns a condo. So they're still home policies. So if you're renting a place, as long as you have $300,000 liability and you have auto insurance, right, with a $250,000 minimum bodily injury limit, you can still buy an umbrella. Right? Don't think renters have less to sue for than someone who owns a home. Okay, so be wary of that. All right, so you got to have minimum $300,000 on the personal liability. You got to have a minimum $250,000 on your auto liability, right? And a lot of times we use split limits like $250,000 and then $500,000 or $250,000, $500,000. We call split limits. As long as you have a minimum bodily injury of $250,000, you can get an umbrella. And you only need those 2 coverages. You need personal liability and auto liability minimum in order to get an umbrella. Now you can't get personal liability and auto liability with the minimum liability limits. Okay, like a $100,000 on a home and $15,000, or depending on your state, you get the minimum in primary policy and then get this cheaper umbrella. No. You got to maintain adequate amounts of coverage under these primary policies before you can get an umbrella. So if you have a boat, you want at least $300,000 on the boat to be covered, and then anything above that, your umbrella can kick in. Okay, so heads up. Now remember, these are primary. That means if you hit someone with your boat and they're injured and they sue you, your boat owner's policy will pay up to its limits, in this case of $300,000, and then your umbrella policy kicks in up to whatever limit, usually $1 million or more, right? So if you had $1 million, that'd be $1.3 million worth of liability coverage associated with your boat. Now, every once in a while, you're going to have a liability exposure that is not covered by one of these underlying policies. Yet it can still be covered by the umbrella. But since you don't have a primary policy and umbrella is an excess policy, you'd have to pay something before the excess policy can kick in. Now, this is called the self-insured retention, which, to be honest with you, is basically a deductible. So let me explain. Let's say you have a house. You have a personal liability of $300,000 on your house. You rent out one of the rooms, okay? Because maybe your kids graduated, you got an extra room, you rent it out to help make some extra money for whatever reason, okay? Now that you're a landlord for that room, you should get personal injury protection or personal injury coverage. Right? Personal injury coverage doesn't really cover bodily injury. It could stem from bodily injury, but in most cases, personal injury is more of a mental thing. Things like unfair discrimination, sexual harassment, wrongful termination, where they felt they were harmed and they sue, okay? And so you have a personal liability on your home policy for $300,000. You didn't get the personal injury coverage, okay? And so, but you have an umbrella policy. And so your tenant, for some reason, doesn't pay rent and you evict them, Right? They don't pay rent, you got to kick them out. Well, this person talks to an attorney, and then they turn around and sue you for wrongful eviction, claiming that you're, discriminating against them because they have purple hair. All right. Now, you didn't get personal injury coverage under your home, so it's not going to cover it. But if you have an umbrella, you can pay a self-insured retention, which is basically a $250 deductible, and your umbrella can still cover that loss, that liability exposure. Okay, so again, umbrellas, higher limits, broader coverage over, your primary coverages, or if there's no primary, you pay a deductible, and then the umbrella can still cover it if it's a liability exposure. Excuse me. Okay. All right. Now, there is a difference between excess liability and umbrella. Right? Umbrella, remember, higher limits and broader coverage over multiple lines. Right? At least personal liability and auto liability to get an umbrella, but you can have both. And of course, you have that self-insured retention. Excess liability is additional liability only over one line. So let's say you have a house, you don't drive. Maybe you live in a metropolitan area where you rely on public transportation. Use Uber, Lyft, what have you. So where you don't own a car. And so umbrella, you wouldn't qualify because you don't have auto liability. And so you can just buy an excess liability policy over one line of coverage. And again, it's like an umbrella, $1 million or more of additional liability, but only over one line of coverage. Whereas a personal umbrella is over multiple lines. Okay. So depending on your situation. And you do need to know the difference on this for your exam. We also have umbrellas in the commercial or business world. Again, over one or more basic liability coverages. So if you have a business, right, if you have general liability, you can get liability limits for these sublines, the location of the business called premises and operations, and losses that occur away from location, which is products and completed operations. Right? Maybe you have a commercial auto and you have auto liability for your business, use of a vehicle, or maybe use vehicles in your business, and you get like a 1 million limit. You can get a commercial umbrella to cover the excess. Under your workers' compensation policy, workers' compensation covers your employees, and it basically provides medical, income, death, and rehabilitation benefits if they're injured on the job. What if your employee is a doctor at a hospital, they contract a rare liver disease, and they go home and give it to their spouse? Well, that doctor would be covered under workers' comp, but the spouse wouldn't be because they don't work at the hospital. But that spouse got the disease from the doctor who works at the hospital. And so that doctor's spouse could actually sue under the employer's liability section of the workers' compensation policy, and it could cover that medical care. Right? And so if it's a lawsuit, there's unlimited lawsuit potential under that employer's liability section of that policy. And so you may want to get like a certain amount, maybe $500,000 or $1 million for employer's liability, and then get a commercial umbrella to cover anything that exceeds that amount. And again, as a business owner, you might have liability exposures that are not covered by a primary policy. They can still be covered by the umbrella, but you got to pay that self-insured retention or that deductible. Now remember, for personal umbrellas, the self-insured retention is about $250. It's very common. For commercial umbrellas, that self-insured retention is usually $10,000. So it's a $10,000 deductible to use your commercial umbrella to cover a liability exposure that isn't covered by one of your primary programs. All right, that's how you want to understand that. Okay. So homeowners, just want to review this as a package policy. Section 1 covers property. Coverage A is a dwelling, which would be this house right here. A pretty nice looking picture here, right? Coverage B is other structures like the fence, right? Maybe they have a pool up here. Personal properties, all their belongings, right? Their furniture, their clothes, right? Dishes, pots and pans, salt and pepper shaker. Right? And those are all direct loss coverage, direct physical loss, damage, or destruction to your property. Now, if the house burns down, well, you need money to stay at a hotel till we rebuild your house. Well, that's coverage D, loss of use of a building. And this is an indirect or consequential loss coverage. Because of the fire, we now have to cover the cost to put you up at a hotel while we rebuild your house. Right? So it's indirect. So Section 1 is property. Theft is included, by the way, in Section 1. And then Section 2 is liability. Now, liability is broken down to personal liability and medical to others. The medical to others you can view as that covers, like, you have a cocktail party at your house, someone slips and falls, and they hit their head on the ground. Medical covers the ambulance ride. It's usually like $1,000 to $5,000 is that limit. And then that's getting them to the hospital. While they're in the hospital, they're racking up medical bills, right? And they're not working because they're recovering from this injury. Well, that's the liability portion. Right? And so that's kind of how homeowners works. Okay. All right. Now, let's say with a homeowner's policy, it's kind of cool that your personal property, just like your liability, covers you anywhere in the world. Excuse me. But with some of your personal property, we have sublimits. A sublimit is a limit on a certain type of loss within the overall policy maximum. So if you bought a homeowner's policy, coverage C basically covers your belongings at 50% of whatever the coverage A limit is. Right? So if it costs $600,000 to rebuild this house, right, in that previous screen, we're going to give you 50% of that, which is $300,000 to replace all of your belongings in that house. Now, there's an exception. For theft of jewelry, there's a $1,500 sublimit. That means if you have jewelry that's worth more than $1,500, your homeowner's policy isn't going to pay more than $1,500 to replace it. This is called a sublimit. It's a limit on a certain type of loss within the overall policy maximum. So like I said, theft of jewelry has a $1,500 sublimit, even though coverage C has a $300,000 limit. Right? Because remember, coverage A will say $600,000, and coverage C is 50% of that, so $300,000 to replace your belongings, but the maximum we'll pay for theft of jewelry is $1,500. Maximum pay for theft of silverware is $2,500. The maximum the policy would pay for theft of firearms is $2,500. If you have a trailer, whether it's used with Watercraft or not used with Watercraft, there's a $1,500 limit. And for cash, the maximum you'll get for money is $200, whether someone breaks in and steals it or your house was destroyed and you had the money in your mattress. The maximum pay is $200. These are sublimits. So if you have jewelry that's worth more than that $1,500 and you want to properly protect it, then you might want to get what's called a floater. Now, even though jewelry typically doesn't float, this is old maritime law terminology that we just kind of still use today. It's kind of a personal lines classification of what we normally call inland marine coverage. And again, even though it says marine, inland marine, okay, it has nothing to do with boats like our boat owners policy. Okay, back in the olden days when people moved, they kind of packed up all their personal property and put it on a barge, and they'd either towed it upstream to the destination or let it drip downstream to wherever they were moving to. And so when someone moved, they go, oh, look, hey, there goes a floater. Billy's moving, you know, and it just kind of stuck. Now, floater just means personal property in transit. Now, that's kind of how it's known, but some of your personal property may never leave your house. It's still called floater coverage. It's still part of the inland marine category. All right. So we have different types of floaters. The most common ones that you're going to deal with is a personal property floater and a personal article floater. This is a PPF. This is a PAF. All right. Now, the difference between the two is personal property floaters on schedule. So let's say you have a little more jewelry than the $1,500 that your homeowner's policy will afford, but not much more. You know, you have a little more than $1,500, but no more than $10,000. Okay, and so we're going to cover that jewelry under a personal property floater. So unscheduled means I don't need a list. All right, you can get higher limits on that jewelry. We're going to cover your jewelry on an all-risk basis. That means, again, pay attention to exclusions. Wear and tear is an exclusion. All right, so yeah, we won't cover that. We're also going to cover your jewelry on a replacement cost basis. what does it cost to replace this jewelry that was stolen, right, or burned up in the fire. Another cool thing about your floaters is it's covering your jewelry anywhere in the world, right? But there is a limit, right? So we'll pay more than $1,500, but we'll say no more than $10,000. Now, this threshold limit is different for every insurance company. I'm just plucking the $10,000 limit out of a tree, right? So you just have jewelry that it's worth more than what your homeowner's policy will pay, but not much more, right? More than $1,500. But no more than $10,000 if your jewelry's stolen. Right? If it's worth more than the $10,000, then you're going to go to a personal article floater, and this is where you're going to need to schedule your items. Schedule means I need appraisals. I need to know what it is, the cut, clarity, quality of that stone, right? What type of a band is it? Platinum or gold, and what is the value of it to replace it? And so that's what schedule means. I need an itemized list with the value, appraisals. And so it's going to give you higher limits on those target items. It is all risk because it's a floater, covers, all risk, pay attention to exclusions. We're going to cover your jewelry on a replacement cost. And it is worldwide coverage, just like your personal property floater. But we need appraisals in order to insure it. And so you have your homeowner's policy to cover if you don't have a lot of jewelry. If you have just a little bit more than a home policy, then you can go to your personal property floater. And if you got some high ticket items, then you go to the personal article floaters. Now, there's another type of program called personal effects floater. And it's just kind of what it says, personal effects. That means what you're carrying on your person as you're traveling around the world. All right, so it's unscheduled. So it's anything you have with you. That'd be your camera, your passport, your traveler's checks, right? And anything you have on your person when you're traveling, backpacking across the U.S. It does cover those items on an all-risk basis, and it does cover it worldwide. But this is very limited. It only covers you while you're traveling, and something happens while it's on you. All right, so it's a little bit different than over here. So again, summary, your homeowners has sublimits. If you have more than the home policy, then you go to the personal property floater, right? Because there are some limits. I'm just using 10,000. If it's more than 10,000, then you go to that personal article floater, and we do need appraisals. Right? Third-party material that backs up your claim that, this is what it's worth. Most of your companies, as long as the appraisal is recent, I've seen some companies go back as far as 3 years, we can still cover it, okay? But the more current the appraisal is, the better off that the customer will be. All right, flood coverage. Next topic here. So flood loss covers flood. Pretty simple, pretty straightforward. Flood is not covered by your homeowner's policy. It specifically excludes floods because flood's catastrophic in nature. In order to be classified as a flood, it's basically the accumulation of water on normally dry land area, and the area must be at least a 2-acre area in order for it to be a flood. Now, the insurance companies don't set the floodplains or the flood zones. FEMA sets the flood zones. Right? So FEMA kind of created the National Flood Insurance Program back in 1968 to provide coverage for those people that have repetitive losses, such as flood. So it's offered through the National Flood Insurance Program, right, overseen by FEMA, because remember, FEMA sets the flood zones. In order to buy flood coverage, you got to live in a flood zone. So if you don't live in a flood zone, even though you may want to, you cannot buy flood coverage. On the regular program, right, we're going to give you up to $250,000 for the building, the structure. It's actually the main living dwelling. I shouldn't say structures, but it should be the main living dwelling, okay? But it can also be used for business, so it be business structure and or home structure, okay? And up to $100,000 for contents. I mean, that's it. That's all you get. So if it costs $400,000 to rebuild your house and it's destroyed by a flood, you're only going to get $250,000 for the structure because that's the limitation on the policy. Flood insurance is for residential and commercial structures and content. So not only does it cover the home, it covers your contents in the home, not your lawn furniture. And it's only the main house, so your separate garage won't be covered. And your fence won't be covered. Like I said, your lawn furniture won't be covered. And what's really cool about the flood insurance program, it does actually afford you with money to try and protect and preserve your property from flood. So here's some money to get some sandbags to protect your property as much as you can from an oncoming flood or possible flood. Now, in order to sell flood insurance, after you get this license, you pass this test and get your license, you need to do a 3-hour course of continuing education on flood in order to write it. They want to make sure you know flood coverage and how it works and the limitations before you sell it. And so that's what you're going to get out of that 3-hour flood program for continuing education. It counts towards your requirement for license renewal. Most states require 24 hours every 2 years for continuing education after you get this license. And so 3 hours of it could be flood. Another 3 hours could be ethics. And so out of the 24, that would take care of 6 hours. So you just have to do 18 hours and other choices. But that's flood. Again, it's provided by the National Flood Insurance Program, which is overseen by FEMA. The FAIR plan. One of the test questions you may get is, what does FAIR stand for? Fair access to insurance requirements. And so you have a really nice house, and let's say you have a really nice log cabin up on the hillside in the middle of brush fire country. That's a high-risk home. I mean, you're living in a log cabin, which you're living in a house made of firewood in the middle of brush fire country. That's a high-risk home. Most of your insurance companies don't want to insure you because you're so high risk, but you need the coverage. And so if your normal insurance companies won't write it, then they'll pass you off to the California FAIR plan. Another type of risk associated with the FAIR plan is you have a really nice house in a really bad part of town, subject to civil disturbances. That's also a possibility for the California FAIR plan. All right. And every once in a while, you'll see it called differences in conditions coverage, or DIC coverage, because the FAIR plan covers a structure for certain perils, which we're going to get into. And then your policy, your company may offer a program that fills the gap. All right. And so this is, I probably got that backwards. So the FAIR plan covers a structure with limited perils, and then your company has a policy called an endorsement that fills in the gaps. And so that would be the differences in conditions coverage. Right? It doesn't cover what's already covered. It covers what's not covered by the program. So under the FAIR plan, it's coverage for the main dwelling. Fire and lightning is the coverage. You want to add extended coverage. Remember, extended coverages are the 7 additional perils: windstorm, hail, aircraft, riots, vehicle explosion, smoke. So you can add those on. And you can also add vandalism and malicious mischief. So it's basically just coverage for the main dwelling, a fire and lightning coverage. You can add this, you can add this. And I would recommend that, biased opinion, you should check in on all these boxes, okay, if you're going to write through the FAIR plan. And pretty much most states have a FAIR plan. Kind of how this works is, again, you live in a high-risk area, most companies don't want to touch you. Because the probability or possibility of loss is increased dramatically because of the brush fire area. But you got to have coverage. So what your states basically do is they get all the insurance companies that are admitted in your state to write homeowners or property policies. They gather a representative, in a sense, from all these companies, and we put them in a room. And then we take all these high-risk homeowners, right, that got rejected by insurance companies. We put their names in a hat, and then we pass the hat around. Your insurance companies pick a couple names out of the hat, and they have to offer them a standard property policy or dwelling policy at mandatory rates. And so the company that you first applied to might have rejected you, but when it gets passed to the FAIR plan, they might have picked your name out of the hat, and now they have to offer that plan to you. Okay? The automobile assigned risk program is kind of the same way, but that deals with auto insurance. So this is high risk homes. The assigned risk program is for high risk auto drivers. kind of the same thing, kind of a round robin lottery of insurance companies plucking your name and required to provide that type of coverage to you. Earthquake coverage, again, typically excluded by your homeowner's policy because, again, just like flood, it's catastrophic in nature and not going to be covered. And so in order to buy earthquake coverage, well, you got to buy a home policy first. Even as a renter, getting that HO4, you can actually get a mini earthquake. They call it the earthquake mini policy because let's say you're living in an apartment and that apartment is destroyed because of an earthquake. You need money to live somewhere else. Well, guess what? You can get earthquake coverage to kind of oversee your renter's policy or with the renter's policy or connection with a renter's policy, just so you know. And so the earthquake program does accompany a home policy. Some companies, they can add earthquake by an endorsement, or you can buy it as a separate policy. In commercial, you can buy earthquake three ways. Number one, a separate policy like we have here. Could be an endorsement added to your commercial property policy, or it could even be a cause of loss form on a commercial property policy. So there's three ways of buying earthquake coverage in commercial and two ways of buying earthquake coverage on the personal side. Again, separate policy or endorsement. If an earthquake destroys your house, there's typically a deductible that needs to be paid. Usually the deductible is expressed as a percentage of the dwelling reconstruction cost. And so if you have like, $600,000 to rebuild your house, you may have a 10% deductible. That means that's a $60,000 deductible for you to pay if an earthquake destroys your house, and then we can start rebuilding. To be honest with you, if it is a total loss, your earthquake program will pay the claim minus that deductible. Okay, so you don't have to pay it up front. They can start the construction, right? And maybe just get a small loan to cover that deductible if you don't have it. Now, for the contents in the house, the minimum amount you can get is $5,000. You can always raise it up, right? And to cover the cost to put you up at a hotel because you lost your house because of that earthquake, we call that additional living expenses. Your earthquake policy minimum is $1,500. You can always buy more. So you can, buy down the deductible. By lowering your deductible, you're going to increase your premium. You want to raise your personal property coverage. You want to raise your additional living expenses. Again, it's going to be higher premium. But it's something that you want to sit with your clients, explain the coverages, and have them choose. Right? How much coverage versus, having that deductible, raise the deductible to save money, to offset and get some better coverage. Right? You can also get the building ordinance coverage. I've seen a standard limit of about $10,000, okay, that they'll pay for building ordinance. Now remember, building ordinances, your house was built several years ago, and if it's destroyed, to rebuild it, we have to rebuild it to meet current building codes. So if you had a house in the 70s, typically didn't have sprinklers. But if you had a fire, it was destroyed by an earthquake, to rebuild it, now you have to put in sprinklers because in most areas they're now required. Well, the insurance company isn't going to give you free sprinklers because you didn't have it before the fire. We're not going to give it to you after the fire. And so you can buy the building ordinance coverage, and that will help cover that increased cost of rebuilding your house and rebuilding it to meet the current building codes. So again, you want to recommend it, explain it, recommend it, and they can choose whether or not they want it. All right. So, that was in a nutshell tonight's material. So if you haven't registered, consider it. But at this point in time, let's open it up to questions. Any questions you guys have? I'm going to unmute you here. All right, no questions? You guys got all that? You can chat in if you do have questions also. All right. I guess we're good to go. So, all right. Just want to say thank you for taking some time and hanging out with me. I am going to post this. So let me pause this recording here.